Now, I'm only on rule 3. I got 36, but some of this I've covered, so I'll go quickly through it. Look for the 2 major trends a day, one in the morning, one at night. And I realize this isn't rocket science, but you got to know this stuff, and the more I repeat it, the more you hear it, the more it's apt to sink in. 2 trends a day, morning and afternoon. Now let's say you get in the morning trend and something goes wrong and you have a loss and maybe you reverse and you lose again. My rule is 3 losses in one session and I stop. And I'll tell you why. If you have more than 3 losses, there's no saying you won't have 4, 5, 6, 7, 8. And if you get into a search and destroy day, a day when they take out the highs, they come back, they take out the lows, they go back up, take out the highs and back, theoretically, you could have an innumerable number of losses in a row. So there has to be a point where you pull the plug on that trading session. And then I step away from the screen, I go eat lunch, I go do errands, I pay bills, and I come back fresh in the afternoon. The psychological part of trading is very important to remember. I mentioned the notion of 2 legs to each trend. They have comparable value, they have comparable time, and they're divided by the consolidation period and highlighted by an equilibrium price, a given price where 2 consecutive closes are identical. And as we get in this, you'll further into the material, you'll see that the equilibrium price is very important because that's the price you're going to measure the second leg by. On page 28, I have an illustration of the leg, the equilibrium, and the second leg, and the symmetry that's involved. And on 29, I have it going the other way, the leg up, separated by the equilibrium, and then the second leg. On 30, I have a morning trend up, and this is important, and the afternoon trend down. This is on a 5-minute. And again, I look at the 5-minute because it gives me the overall trend on the day. But this is not to say that you can't look at 10-minute, 1-hour, daily, even daily charts and see the long-term trend in this market and some other markets. Remember the nature of a symmetrical market. If you have so many points down in the morning and you have an equilibrium and so many points in the afternoon, that's a downtrend day. But what if you get a V pattern, so many points down in the morning and a comparable number of points up in the afternoon? You get that. You get the inverted V, up in the morning, all the way back in the afternoon. And go to your trade station, to your screen, and you'll see how symmetrical these patterns can be. Not only will it retrace the entire move in the morning, but it'll go a few ticks lower. And this isn't an accident. This is where the stops are. This is where it's supposed to go. And then only then there'll be a bounce into the close. So if you know about this kind of symmetrical thing, you'll know what to look for. On 31, I have a morning trend down, one-way down essentially, a sort of a spike at the bottom, and then it spends a lot of time going back up again to the middle. And then it starts to fail again, it holds, and then there's a wonderful rally into the close, straight up going out to new highs. When you think about it, this is why trading is so frustrating to so many people. They think they've got it right, they wrote it down, they didn't get out, now they're holding on to it, so they got to ride it back up again. Then they're hoping it'll go down, it looks like it's going to work out, it starts to work out, and then everything's turned around and it screams the other way. And this is why I like this short-term trading so much, because you got the trend, you know what to look for, you get in, you grab the profits, and you leave, and you don't get caught up in all these counter trends. Most of the day, the market's just choppy. But if you look on this chart, you'll see, and this is a 5-minute, and if I just count the bars, there's 5 or 6, maybe 7 bars straight down. That's 35 minutes, 25 minutes to 35 minutes. In the afternoon, it happens to be a little longer. I haven't mentioned gaps really, opening gaps, but and I want to talk a little bit about them here. The open is a time of day where there's a lot of opportunity, but a lot of traders don't want to get in on the open because they don't have much to work with, and there's a lot of uncertainty. But this is the paradox of the market in the sense that the more uncertain it is, the better the opportunity. For instance, if the market's going down and it gaps up to a high and it sells off of that high, there's a high probability that that high won't be violated the rest of the day. I know these probabilities when I trade. I know there's a very high probability that either the high or the low of the day is made in the first hour. We have the actual statistics in my book, Profitable Day Trading with Precision. You might want to look at that. And then there's a very high probability at the end of the day that the high or low would be made. Now, I'm not saying that it's made every single day in the first hour or the high or low is made, or every single day the high or low is made in the last hour. I'm just saying that there's evidence in terms of the probabilities that there's a high likelihood that they will be. That gives me the confidence to take a trade into the unknown. In the sense, what I'm talking about is embracing the uncertainty. It's the people who want certainty who always lose, because once it's certain, everyone knows about it, and then it won't work, or it's already worked. When I was a new trader, if I wanted to buy, I'd wait and watch it for a while. Then it would go up, and I'd watch it and say, gee, I think I'm right. Then I'd watch it go a little more right, up. Then I knew I was right. So what would I do? I'd buy it. That'd be the top. Then it would sell off. There isn't a new trader around who hasn't made this mistake. The time to get in is when nobody knows very often, and that's where the gaps come in. Now, the word fade, when you're trading gaps, means to trade against. So if I'm fading an opening gap, I'm trading against it. If it opens to the upside, I'm selling it. If it opens to the downside, I'm buying it. But it's not as easy as that, unfortunately, because there are different types of gaps. There's extreme gaps, there's ordinary gaps, there are gaps which are filled in the first minute. This is why you got to know your market. So in terms of the S&P, if I see a gap of, say, less than 500 or 600 points, it's usually a good fade because the probabilities are approximately 3/4, 75 to 78%, that gap's going to be filled. Now, what do I mean by that? I mean, if you have a place on the chart where there's no trading from yesterday's close, it gaps up here, there's a high probability, even if it's going up on the day, that it's going to come back to that closing price yesterday. So the probabilities favor me selling that. But it's not even as easy as that, because how do you know if the first minute is going to be the high, or it will gap up, go higher, make a new high, and then sell off? You don't know. You just don't know. So what you have to do is make some sort of a judgment about, I'm going to sell this gap up. What it should do is close the gap and go to the prior day's close, and that's where I'm going to buy it. And of course, there are days when it gaps up, it fills the gap, and it goes a lot lower as well. And then there's that tendency to want to kick yourself and say, why did I get out so soon when I actually sold the high of the day? So the general rule is the gap will be closed. When you fade a gap, look for the market to trade down from an opening up gap, or to trade up from a gap down to the prior close. Once that's completed, what I call the trade being fulfilled, it's over. Then you have to go on to something else, the time and price trade, for instance. But once it's over, and then you have to get out and start over again. So remember that. Now, it's a bit more complicated than this, because what you will get if there's news in the market, you'll get a big gap, an extreme gap. Now, when that happens, again, the paradox kicks in. The market is safer to buy a lot higher up than it is near yesterday's close. If it opens unchanged, it doesn't mean much. If it opens extremely high, it means it wants to go up, and it wants to go up in a big way. So if you fade that gap, you could be in a lot of trouble selling it up there. The metaphor, the analogy I use is that of a spaceship being sent up to go into outer space. If you send it up just a little bit and it's still in the Earth's atmosphere, if you cut off the power, it would fall back to Earth. Once it gets into outer space, it keeps going. And it's the same way with the market. So you have to remember the basic rule is the market's never too high to buy and it's never too low to sell. And we've seen evidence of that in this recent S&P market, which is at all-time new highs. Who would have ever thought it would have gone this far? Probably no one, but it has. And if you tried selling it, it wouldn't have worked out. So remember that. So here on 33, I've got some of these rules. Fade the gaps not above the previous day's high or the previous day's low. Now, I haven't mentioned this, but this is important too. If it's above the prior day's high, then you're talking about new high ground very often, and the likelihood that it'll fill the gap isn't as great. The rule is, and the opposite is true on the downside. The rule is the gap will be filled, and the previous day's close acts as a magnet. Think of a spring that you pull apart. You let go of it, and it goes back to the middle. The market's the same way. Everything tends to trade back to the middle in the market. So you have to be prepared for that, and that's what should happen. On 34, we have you'll see that light line there, which is the new day. You have a gap up. It goes higher. In this case, it's a 5-minute. It goes higher really for 20 minutes where it stalls out, and then it makes the real move of the morning, which is a sharp sell-off from there. Anyone familiar with the work of Taylor that I base my 3-day cycle system on knows the notion that the market is engineered, that it goes up to go down, that the open is often a running of the stops, the overnight stops. Once the stop buying or selling dries up, it goes the other way. This is, commodity trading 101 for those who've traded for a while, I understand, but it's important to know these things. It's important to know how your market, the market you're trading, behaves. This is why you won't find traders on the floor going from pit to pit and picking a new futures to trade each day. Everyone trades the same thing every day. Not only that, they stand in the same place, the same exact spot in the trading pit, because they want the order fillers to know where they're going to be if they need them. If a guy's a 20-lot trader and somebody needs to get out the paper or the order filler, will look for the 20-lot trader because he doesn't want to have to get out in terms of ones. The rule on the floor is no one ever forces you to take a bigger position than you want. So if I want to do 20 and you want to do 1, we do 1. And that's why they stand in the same place every day. Not only that, they do the same kind of trading every day. So one trader will be identified as a scalper, which means he just wants to buy the bid and sell the edge. He doesn't really care about price rejection. Another trader will want to position it during the day, which in a sense is what we're trying to do, but in a very aggressive short-term type of way. Another trader will spread the back months, and he's a specialist in that. So you want to become a specialist, and what we're talking about here is becoming a specialist in this aggressive short-term day trading. When I first started trading, I wanted to get the lion's share of the whole move. So if it went, say, back then, I've been trading the S&P since it started. If it went 300 points, I wanted 250 of them. Well, some days I got it, but most of the time I didn't get it, and I got chewed up because I was giving back profits I already had on paper. So what I want now is just a little piece of it, and that's all you need in this market.